Hello, welcome to this podcast. My name is Nivedita Roy from Mirae Asset Sharekhan. Today, we're interviewing Mr. Neelesh Surana, the Chief Investment Officer of Mirae Asset AMC. Welcome to this podcast, Mr. Neelesh. It's really great to have you here today.
Thanks for inviting me, Nivedita. It's my pleasure.
So, before we get into the investment framework of Mirae Asset, I would just like to know about your journey. You have over 30 years of experience in investments and in equity research, right? So, could you tell us a little bit more about your background and your journey?
Yeah, I did my engineering and then I was in industry for 2 years prior to shifting gears and moving to finance. And thereafter, in the financial services, I initially worked as sell-side research analyst, just like you have Sharekhan and also I was covering a couple of sectors. And subsequently, I joined a portfolio management house for 4 years. And then in 2008, since then, I've been associated with Mirae Asset AMC when we started the operation. So it's almost 18 years with the company. Yeah.
Okay, so that's been quite a long time. So, can you tell me what the investment framework of Mirae Assets AMC is, and what are the tenets of this investment framework?
Yeah, that's a very important and pertinent questions to start with. And as you know that we are managing north of 2 lakh crores across various schemes. We are seventh largest on the active equity sort of mutual fund sort of space. On the each of the product has a different mandate, but the common investment approach as a house, now, I would bifurcate that into two pieces. One is what is the stock selection approach, which how do we identify, select, invest, and do maintenance coverage on those stocks. And second is how portfolios are constructed. So on the stock selection approach, there is a 21 member team which does research and they scan so many companies, more than 650 companies we track. And what stocks come in the portfolio depends on the businesses which want to participate. And within that also there are nuances in terms of how do we select the underlying business, how do we evaluate the management which runs that business, and it's a part of the evaluation of the business, and how much you pay for that. So there are various sort of filters in selection of business, evaluation of management, and how much you pay for that stock. And very quickly on each of these, it's a long answer, but it's each of these in terms of business selection is we look at businesses which can create wealth over a longer period of time. So equity is about growth, India is about growth. So essentially, we look at growth-oriented businesses, provided the growth is value accretive. So there is a term called return on capital employed. So we try to look at businesses which first are growing more than nominal GDP growth, where the return on capital employed is again internal filter is north of 15% pre-tax. On both these metrics, higher the better. Then of course, when we look at any other aspect on the stock, as I mentioned that management evaluation is very important. So we look at various qualitative and quantitative sort of filters and the background of the management which is sort of running the business. And lastly, a good business need not be a good stock. So we have to look at the framework of how do you value those stocks. So all these put together essentially means that we are participating in growth oriented businesses, but we have to be cognizant that we don't overpay for it. So growth at reasonable price, which is a very common term which is used, we try to execute that and scan across sectors and cover more than 650 stocks. So that's one aspect where all fund managers and analysts sort of look at identifying those businesses which can create value, and essentially the starting point of valuation is I'm trying to stress is important. The second tenet or second aspect in terms of how portfolios are constructed, because there are various funds, there are various mandate, is the attempt is to create a risk-adjusted portfolio. So when I say risk-adjusted portfolio, is you have to see it in context with the benchmark. So attempt is to deliver better returns on the benchmark on the longer term, on a 5-year, 10-year lens, and without taking too much of sort of risk. So here it is important to have a diversified portfolio. Diversification is business sector wise, obviously. It also depends on the character of the management and style wise. And when I say diversification, it should be seen how much we are deviating also from the underlying benchmark. because our mandate is to outperform the underlying benchmark. In India, benchmarks have also created huge value, all of us know. And idea is to generate alpha, which is returns over the benchmark over a 5-10 year lens. So these are the two essential sort of, I would say, factors where the entire team of 21 member research and fund management team, they look and identify a stock, construct portfolio. And having invested in those stocks, the job of the team of fund managers and analysts is to do regular sort of coverage in terms of the investee companies and also hunt for new ideas. But that's the broad framework under which we sort of work. And for each of these, what I mentioned, there are numerous set of processes. So it's a very institutional setup where the research team cover a lot of stocks. We come out with ideas, invest in a risk-adjusted manner so that the fund is able to deliver a risk-adjusted return consistently over a long period of time.
Okay. So mostly growth-oriented stocks without overpaying for them and risk-adjusted returns.
Yeah, I would say that. I would say that ideally that what we have seen in the longer term, that good quality businesses create huge wealth. And when say quality, it is two vectors, growth. And the character of growth is it has to be value accretive. It has to have better returns on capital investment.
Okay. So how does this approach stand apart from investment frameworks by other AMCs? So how does this differentiate from other AMCs?
A good question. I mean, I would say that by and large, most well-managed fund houses would have, I would tend to believe that would have similar approach, that you want to participate in good stocks and not overpay for it. Yeah. And essentially, it happens to be growth, not overpaying for that growth. I think what differentiate or what would differentiate ultimately, first of all, in this business, you look at the past return, past track record over the last, say, 18 years of our we have been there. There are products which have 17-year, 15-year-old. But it's more to do with the execution. The approach may be to identify good business and not overpay for it, but it's easier said than done. So I think the key is what is the foundation of research. And here both, it's not the width of the coverage, it's also the depth of the research. So how deep we go, when I say we, it is not only the fund managers, also the analyst. We try to do a lot of primary research. Primary research means our own research. So I think what differentiate any active asset manager is what is the depth of the research. To my mind, that's the most important thing, because that's the foundation bedrock in terms of how you can get deeper understanding of the businesses. Then you can make a frame of view on valuation and sort of try to identify so-called market inefficiencies, because price is known, value is what we have to ascertain. And value of for no two people may be same, because for any stock, if someone is selling, someone is buying, there is always a contra trade happening. I think our approach is to intensify or strengthen various processes in terms of the team, the depth of the coverage, and that I think there is an attempt to have a very intense primary research. In addition to the own research, we also get service from various broking outfits. That I would say it's secondary research. But overall, I think what the attempt and the endeavor is to have a very strong research as a foundation which supports the fund management team, so that the errors in terms of assessment of the business or management or valuation, each of these is minimal.
Okay, so primary research is the key differentiator in this case.
Absolutely, yeah.
All right. So can you discuss some of the flagship schemes that you manage and the key performance drivers behind these flagship schemes?
Yeah, so we started, as I said, 18 years back. So one of our scheme, which is managed by my colleague Gaurav Mishra, with a large cap fund, has completed more than 17 years. Okay. And the other flagship scheme, I'm looking at from the how long those schemes have been. The second scheme is earlier what was called as Emerging Blue Chip Fund, which is now called Large and Mid Cap Fund, okay, which is managed by Ankit Jain and me. And that is also completed. In fact, it has completed 15 years in this calendar year in 2025. And by the way, in last 15 years, it is 17x the NAV. And so that's delivered very satisfactory return. And another scheme which is on more than 10 years, will be completing 10 years this month, is a product on the tax saving side, which is called the ELSS fund. Beside that, we have a host of other products which have completed 3, 5, and less than 10 years. But these are the three schemes which have almost 10 years and more track record.
Okay. So now that you explained the flagship schemes and also the investment strategy that you follow, now many investment strategies may work well during bull runs, but the real test is how it performs during market corrections. So, how does the growth at reasonable price strategy perform during, let's say, the recent market corrections?
Yeah, so I mean, in last 18 years or last 10 years, as whichever product you look at, we have seen enough more and more market cycles, including some of the drawdowns post global crisis, and then last serious drawdown was during COVID and all. So what's important is how a particular scheme has performed over a 3 to 5 year period, and the consistency of that across the time series. And in that context, most of these fund, for example, I mentioned about the large and mid cap fund, which has completed 15 years, or ELSS, which is completing 10 years. The returns over the benchmark in the past 15 years in this case and 10 years in the ELSS scheme is north of 3-4% over and above the benchmark. So if the benchmark has generated 14-15% return, these products have generated 18-19%, which is a very strong multiplier on compounding, despite markets having its own set of cycles. Sometimes a particular style work or certain style don't work. So I think consistency in performance is extremely important, and the longer term track record, I think, even out what you are mentioning, there can be volatile times for few quarters or sometimes couple of years.
Okay. So, about ETFs, now Mirae is a big player when it comes to ETFs, right? So, can you tell me how ETFs by Mirae differentiate from ETFs by other AMCs?
Yeah, so I'm looking on the active side, which is the non-ETF side, but it's a very, if you look at how our journey has been over time, ETF has grown meaningfully over the last literally sort of 10 years. But I would say that whatever we discussed till now is on the active fund management side. We have a very separate, strong team which is running the ETF business. And we have north of almost closer to 50 odd products and north of 25,000 crore of AUM. And there are two types of products if I have to bucketize it. One is the core or the plain vanilla product. Let's say you would have heard about Nifty 50 ETFs or a gold or a silver ETF. I mean, these are very standard, known, long track record. I mean, people know the asset class and then invest. And then we have some very sophisticated, I would call it satellite or tactical sort of offering to investors. And we have very sophisticated product which the ETF team have innovated, and they have taken advantage of our global expertise in some cases. In some cases, they have created a lot of innovative bespoke benchmark. So we're offering both the products. We are offering the plain vanilla products as well as we are capitalizing on our strength, be it our global expertise in the various markets, launching ETFs on that. We have a FANG product. We have many other products, or the expertise in making bespoke indices and then making products on that. And that's why there is a wide array of products, almost 50 odd products, more than 20,000 crore of AUM, so that investors can pick and choose what is appropriate to their risk profile, what is appropriate to their core allocation, and sometimes what is appropriate to their tactical allocation.
Okay, so basically there's something for every investor out
Absolutely,
there.
absolutely. Yeah.
All right.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully before investing.